This video is not financial advice and just for explanation purposes only. What's up, YouTube? It's your boy Jerome, and unless you've been under a rock for the last week or so, I'm sure you've probably heard about the GameStop short squeeze that's going on by now. Yep, that's that same GameStop that you'd go and trade in 10 to 15 games and they'd give you store credit for about $5. Then you'd go home and you'd smash that like button so you could beat the YouTube algorithm. A little while ago, a group of Redditors on the subreddit r/Wall Street Bets found out that GameStop is one of the most shorted stocks of all time. So what exactly does that mean? To give you a very quick explanation, shorting is when you're basically betting that the price of a stock is going to go down. Let me explain. Let's say that GameStop is currently trading at about $100 a share. If you want to short that stock, what you do is you go out and borrow that share of GameStop for $100 with the agreement that you're going to return it to the person you borrowed it from at some point in the future. Let's say like 30 days. Then you turn around and you sell that share on the market immediately and you get that $100. 30 days from now, if GameStop's price goes down to, let's say, $50, you go and you buy that share for $50, you return that share to the person you borrowed it from, and then now they have their share back, and you have an extra $50. On the other hand, if the price of GameStop goes up to $150, now you're forced to go and buy that for $150 because you still have to return that share to the person you borrowed it from. This time, you've lost $50 on that entire transaction. So what if it goes up to $500? Yep, you guessed it. You're still forced to buy that stock for $500 so you can return it to the person you borrowed it from. So hypothetically, your potential losses are infinite, and it's a really dangerous game to play. Now here's where things get a little complicated. GameStop has been shorted more than there are available shares. So let's say, for example, that there's 100 shares of GameStop that are available in the entire market. So using that example, what's ended up happening is GameStop's actually been shorted for, say, 150 shares. Now, if GameStop's price goes up, those people that have shorted that stock are going to start to panic. They're going to buy GameStop so then they can cut their losses and return that share to the person they borrowed it from. But there are only 100 shares available, and it's been shorted 150 shares. So say people go out and buy up those 100 shares so they can return it to the person they borrowed it from. There's still 50 people out there who need to return that share to the person they borrowed it from, but there aren't any shares available at the price that everyone else bought it for. So what's going to happen? They're going to panic and they're going to offer even more money to buy those shares of GameStop so they can return it. And that cycle is going to continue and just keep driving that price higher and higher and higher. This is exactly what the people on r/Wall Street Bets figured out. Once they figured that out, they basically pooled all of their money together and agreed that they would just hold GameStop and never sell it. So when those short sellers came around and offered $100 for that share of GameStop, they said, nope, I'm not going to sell unless you offer me $300. And what are those short sellers going to do? They're going to offer $300 because they have to return that stock. So these Redditors essentially drove up the price of GameStop until it hit, I think, $470 a share or something like that last week. And I think we can all agree GameStop is definitely not worth that amount of money. But where things get even more interesting is these hedge funds that had shorted millions and millions of shares of GameStop ended up losing billions of dollars, some of them even going into bankruptcy. And now it's raising a lot of questions about financial markets and regulation and whether these Redditors are manipulating the markets or whether hedge funds are manipulating markets. And in the midst of all that, we have Robinhood that steps in and stops allowing people to trade GameStop. And of course, the backlash was incredible. People were furious that they weren't able to buy GameStop anymore, and they thought Robinhood was siding with the Wall Street hedge funds, and they were manipulating markets, and it raises all of these interesting questions like we've never seen before. And while I myself did not play in this game of can we get GameStop to the moon, I think it does raise a lot of good questions about institutional investing versus retail investing and what that landscape could look like in the future. I don't know, but I would love to hear what you guys think in the comments below. Did you play the GameStop game? Do you think hedge funds need more regulation? Do you think retail investors need more regulation? Tell me what you think. If you guys like this video, make sure you hit the thumbs up down below. Make sure you subscribe to the channel and share this video on Twitter, Facebook, whatever, with your friends. Hopefully this explained to you kind of the short squeeze situation that happened with GameStop, and hopefully you understand better about the stock market in general and what a short actually is. Thanks for watching the video, guys, and I'll catch you next time. Peace.